The numbers do not make sense. At least, they do not make sense if you believe the silver market is functioning normally. This morning, silver on the Shanghai Gold Exchange is trading at $150 per ounce. On the COMEX in New York, silver is trading at $97 per ounce. That is a $53 gap, a 55% premium. For the exact same metal, in any rational market, that gap should not exist. Arbitrageurs should buy in New York, ship to Shanghai, and pocket the difference. The buying would push up New York prices, the selling would push Shanghai prices down. Within days, the gap would close. This is how markets are supposed to work. But the gap is not closing, it has been widening, and the metal is flowing in only one direction: east. Every ounce that moves from COMEX vaults to Shanghai is an ounce that is not coming back, and the pace of this flow is accelerating. In my assessment, what we are witnessing is not a temporary market anomaly. It appears to be a deliberate, sustained effort to drain silver from Western depositories and concentrate it in Chinese hands. Whether you call it an attack, a strategic acquisition, or simply aggressive buying, the effect is the same. The COMEX is being emptied. And the implications for silver prices and for the global financial system could be profound. Before we go further, I need to be clear. This is not financial advice. I am not recommending you buy, sell, or hold any asset. Every investment carries risk. Do your own research and consult a qualified professional. I also want to emphasize that when I use the word attack in the title, I am speaking metaphorically about market dynamics, not suggesting military action or illegal activity. China is operating within the rules of global commodity markets. They are simply using those rules more aggressively than Western observers expected. I am not encouraging hostility toward any nation, institution, or individual. This is an analysis, not an accusation. With those important points established, let me show you what is happening and why it matters. Welcome to AG Archivist. Today we are examining the Shanghai premium, the arbitrage flow it has created, and what appears to be a systematic transfer of silver from west to east. Let us start with the basics of what is happening. The Shanghai Gold Exchange, or SGE, is China's primary precious metals exchange. It operates differently from Western exchanges in important ways. Most notably, it is primarily a physical delivery market. When you buy silver on the SGE, you typically take delivery. This contrasts with the COMEX, where most contracts are settled in cash or rolled forward rather than delivered. For years, prices on the SGE and COMEX tracked each other closely, with minor differences reflecting shipping costs, tariffs, and local supply conditions. A premium of 1 to 3% was considered normal, the 5% premium was noteworthy, a 10% premium was exceptional. Today the premium exceeds 50%. Silver that trades for $97 in New York is trading for $150 in Shanghai. This is not a minor discrepancy. This is a chasm. The natural response to such a gap is arbitrage. Traders buy where cheap and sell where expensive, pocketing the difference. This should rapidly close any significant price gap. But for arbitrage to work, you need the ability to source metal in the cheap market, transport it to the expensive market, and deliver it. And here's where the situation becomes interesting. The ability to source metal from the COMEX appears to be increasingly constrained. Let me walk you through the mechanics. To arbitrage the Shanghai premium, a trader would need to acquire physical silver from Western sources, likely by taking delivery on COMEX contracts or purchasing from refiners and wholesalers. They would then ship that silver to China and sell it on the SGE. The profit potential is enormous. After accounting for shipping costs, insurance, tariffs, and transaction fees, a trader could potentially clear $40 to $45 per ounce. On a single 5,000-ounce COMEX contract, that is $200,000 or more in profit. The incentive to do this trade is overwhelming. And indeed, the trade is happening. We can see it in the COMEX vault data. The registered category of metal available for delivery against contracts has declined from over 150 million ounces in early 2021 to approximately 28 million ounces today. That is an 80% reduction. Hundreds of millions of ounces have been removed from the system. Where has it gone? Much of it appears to have gone east. Shipping data, import statistics, and SGE delivery reports all indicate massive silver flows into China over the past several years. The Shanghai premium has acted as a vacuum cleaner, sucking silver out of Western vaults and depositing it in Chinese hands. But here is the puzzle. If arbitrage is so profitable, why does the premium persist? Why has it not closed? In my assessment, several factors are at play. First, the supply of deliverable silver in the West is genuinely constrained. The COMEX registered inventory represents the immediately available pool. At 28 million ounces and declining, there simply is not enough metal to satisfy both domestic demand and the arbitrage flow. Arbitrageurs cannot buy what does not exist. Second, the entities that hold silver in the eligible category, metal stored at the COMEX but not registered for delivery, may be unwilling to sell at current prices. They may be holding for higher prices. They may have their metal committed to other purposes. They may view the current situation as precisely the moment to hold rather than sell. Whatever the reason, the eligible inventory has not flowed into registration as one might expect if holders were eager to take arbitrage profits. Third, there may be practical obstacles to the arbitrage trade that are not immediately visible. Securing shipping capacity for large quantities of silver is not trivial. Insurance costs have risen. Regulatory compliance requirements add friction. And perhaps most importantly, the trade requires capital. Buying tens of millions of dollars of silver, shipping it across the ocean, and waiting for settlement ties up significant resources. Fourth, and this is more speculative, some market participants may be reluctant to facilitate the drain. If you believe, as some analysts do, that the COMEX inventory decline represents a threat to the exchange's ability to function, you might hesitate to accelerate that decline even for substantial profits. The arbitrage trade is not illegal, but it may be uncomfortable for those who have a stake in the Western system's stability. The net effect is that the premium persists and the drain continues, but at a pace constrained by these frictions. The question is whether the current pace is sustainable or whether something will give. Now let me address the question in the title. Is this an attack? The word attack implies hostile intent. It implies a deliberate strategy to harm. I cannot prove what is in the minds of Chinese policymakers or traders. I do not have access to their strategic documents, so I want to be careful about characterizing their motivations. What I can observe is the outcome. Silver is flowing from west to east at an unprecedented pace. The Shanghai premium is creating incentives that accelerate this flow. Chinese entities, whether private traders, state-owned enterprises, or the central bank, are accumulating silver at an extraordinary rate. From a Chinese perspective, this likely makes strategic sense. Silver is essential for their industrial ambitions. They dominate solar panel production. They are rapidly expanding electric vehicle manufacturing. They need silver for their technological infrastructure. Securing supply makes perfect business sense. China has also been diversifying away from dollar-denominated assets for years. Their holdings of U.S. treasuries have declined substantially. They have been accumulating gold at record rates. Acquiring silver fits this pattern of de-dollarization and accumulation of real assets. Whether this constitutes an attack on the Western financial system is a matter of interpretation. One could argue that China is simply acting in its national interest, as any country would. One could also argue that the scale and persistence of the accumulation suggest a strategic objective beyond mere commercial interest. I leave that judgment to you. What I am more confident asserting is that the effect, regardless of intent, is to weaken Western control over a critical commodity and strengthen Chinese control. The silver that leaves the COMEX does not come back. Once it is in China, it is under Chinese jurisdiction and serves Chinese purposes. This represents a real shift in the global resource landscape. Let me share some data points that illustrate the scale of what is happening. According to customs data, China imported over 8,000 metric tons of silver in the past 12 months. That is approximately 257 million ounces. For context, global mine production is roughly 850 million ounces annually. China is importing roughly 30% of global mine production, on top of its own domestic production, which is itself substantial. Where is this silver being used? Some is clearly going to industrial consumption. China's solar panel production has been growing at extraordinary rates, but industrial consumption alone may not explain the full scale of imports. Some analysts believe China is building strategic stockpiles, though this is difficult to confirm since China does not disclose such information. The Shanghai Futures Exchange warehouse inventories have grown substantially, even as Western inventories have shrunk. Metal is being transferred from Western visibility to Eastern opacity. We can see what leaves the COMEX. We cannot see where it all ends up in China. The persistent premium indicates that Chinese buyers are willing to pay substantially more than world prices to secure metal. This is not the behavior of price-sensitive commercial consumers. This is the behavior of strategic accumulators who prioritize security of supply over cost minimization. Let me address the skeptical perspective on this narrative. Skeptics might argue that I am reading too much into market dynamics. They might say that the Shanghai premium reflects local conditions rather than strategic accumulation. Perhaps Chinese solar manufacturers are experiencing a surge in orders and need silver urgently. Perhaps logistical issues are temporarily constraining supply. Perhaps the premium will normalize soon. These are fair points. Markets are complex. Temporary dislocations happen. Not every unusual pattern reflects grand strategy. However, I would offer several counterpoints. First, the premium has persisted for an extended period. Temporary dislocations typically resolve within weeks. The Shanghai premium has been elevated for months, and by some measures years. This suggests structural factors rather than temporary ones. Second, the inventory drawdown is not temporary. The COMEX registered category has been declining consistently, not fluctuating. Each month brings new lows. This is a trend, not an anomaly. Third, China's behavior in other commodity markets supports the strategic accumulation thesis. They have built massive stockpiles of oil, copper, grain, and other essential commodities. They have secured long-term supply contracts for resources worldwide. Treating silver differently would be inconsistent with their overall resource strategy. Fourth, the geopolitical context makes strategic accumulation logical. US-China relations have grown more adversarial. Supply chains have become weaponized. Any country relying on critical inputs from potential adversaries has an incentive to reduce its dependence on them. China's building silver independence is a rational response to an uncertain geopolitical environment. I am not dismissing the skeptical perspective. I am weighing it against the evidence and finding it less persuasive than the strategic accumulation thesis. Reasonable people can disagree. Now let me discuss what this might mean for silver prices and for investors. In my view, the Shanghai premium represents a structural shift in the silver market with significant price implications. Here is my reasoning, offered as opinion rather than prediction. The premium indicates that the marginal buyer of silver, the buyer who determines where the next ounce goes, is willing to pay $150. The COMEX price of $97 represents a legacy price that is becoming increasingly disconnected from the physical market reality. For prices to converge, either Shanghai must fall or COMEX must rise. Given the apparent strength of Chinese demand and the constraints on Chinese supply, a fall in Shanghai seems less likely than a rise in COMEX. In my assessment, arbitrage is more likely to be resolved by Western prices rising to meet Eastern prices than by the reverse. If I am correct, the implications are substantial. A move from $97 to $150 would represent a 55% increase. That would be a significant gain for existing silver holders. It would also have profound implications for industrial users, miners, and the broader precious metals complex. However, I want to be careful about timing. I do not know when prices might converge. The current disequilibrium could persist for months or even years. It could resolve gradually or suddenly. Market dynamics are unpredictable. I also want to acknowledge that I may be wrong. Perhaps the premium reflects temporary factors that will normalize. Perhaps a new supply will emerge to satisfy demand. Perhaps Chinese demand will slow. There are many scenarios in which current prices persist or even decline. What I'm offering is not a prediction, but a framework for thinking about the situation. The framework suggests that fundamental pressures favor higher prices, but they can be overwhelmed by other factors in the short term. Let me discuss the broader implications of what appears to be happening. If China is indeed conducting a systematic acquisition of silver, it represents a shift in the global resource order. For decades, commodity markets have been largely denominated in dollars and centered on Western exchanges. The COMEX and London have been the reference points for global precious metals pricing. That structure gave Western institutions significant influence over commodity markets. What we may be witnessing is the beginning of a transition to a different model, a model where China, as the world's largest consumer of industrial commodities, exerts greater influence over pricing. A model where physical possession matters more than paper contracts. A model where Western exchanges become less relevant because the metal has moved elsewhere. This has implications beyond just silver. If the pattern repeats in other commodities, it represents a fundamental shift in economic power. Countries that produce and consume real resources gain influence. Countries that produce and consume paper claims may find their influence diminishing. I want to be careful not to overstate the case. The dollar remains the world's reserve currency. Western financial markets remain enormous and influential. The shift I am describing, if it is occurring, is gradual rather than sudden. But the direction seems significant to me. For the precious metals market specifically, the shift suggests that physical metal will become increasingly important relative to paper derivatives. If China is prioritizing physical acquisition, they are implicitly saying that paper claims are not sufficient for its purposes. They want the metal itself in their vaults under their control. This validates what many precious metals advocates have long argued, that ultimately physical possession matters more than contractual claims. Paper markets can create prices, but they cannot create metal. When the metal moves, the paper becomes less relevant. Let me share some thoughts on how to think about this situation with the caveat that this is not advice. If the Shanghai premium represents a structural shift, then the price of physical silver in the West may increasingly disconnect from the COMEX spot price. We have already seen this in the retail market, where premiums over spot have remained elevated. We may see it increasingly in the wholesale market as well. For those holding silver, understanding this dynamic may provide context for your position. The COMEX price is one reference point, but it may not accurately reflect what your metal is worth to a buyer who needs it. For those considering silver, the current market's complexity is worth understanding. The nominal price and the actual acquisition price may differ significantly. The relationship between Western and Eastern markets is in flux. The rules that governed the market in the past may not apply in the same way going forward. For everyone, the geopolitical dimension is worth considering. Commodities have become tools of statecraft. The intersection of finance and geopolitics is tighter than it has been in decades. Understanding these dynamics is part of understanding the investment landscape. Let me close with some reflections on what we are observing. The silver market has always been small by global financial standards. Its total size is measured in tens of billions. a figure that is trivial compared to those of stock or bond markets. This small size has made it susceptible to manipulation and to large player influence. What may be happening now is that a very large player, the world's second largest economy, has decided to become the dominant force in this small market. China has the resources to buy all the available silver in Western vaults if it chooses. They have the industrial demand to absorb it. They have the strategic motivation to control it. If this is indeed their objective, they are succeeding. The COMEX drain continues month after month. The Shanghai premium remains elevated. The metal keeps moving east. Each month, Western influence over this market diminishes while Chinese influence grows. This is not necessarily good or bad in some absolute sense. It simply is what appears to be happening. How you interpret it depends on your perspective, your values, and your position. What I think is beyond dispute is that the silver market is in an unusual and historically significant state. The gap between Shanghai and New York is extraordinary. The inventory declines are real. The implications are potentially profound. Whether the title China's attack is the right framing is debatable. What I am more confident asserting is that something significant is happening. The metal is moving. The premiums are real. The arbitrage is constrained. And the outcome appears to favor China at the expense of Western stockpiles. What happens next depends on factors I cannot predict, whether a new supply emerges, whether demand shifts, whether geopolitical events accelerate or interrupt the current trends. The future is genuinely uncertain. What I can say is that the current data tells a clear story about the present. And if the present trajectory continues, the implications for silver prices and for the global commodity order could be substantial. This is AG Archivist. The Shanghai premium has reached extraordinary levels. Silver is flowing from west to east at an accelerating pace. The COMEX vaults are draining, and the arbitrage that should close this gap appears constrained. In my view, this represents a significant development for the silver market and potentially for the broader monetary landscape. But I encourage you to evaluate the evidence yourself and reach your own conclusions. Remember, this is not financial advice. I am not recommending any specific action. Do your own research. Verify the data independently. Consult with qualified professionals. Make decisions based on your own circumstances and judgment. If you found this analysis valuable, please like the video and subscribe to the channel. Share it with anyone trying to understand the unusual dynamics in the current silver market. The mainstream financial media rarely covers these developments in depth. Understanding requires looking beyond conventional sources. I will continue monitoring the Shanghai premium and the COMEX inventory data. The story is ongoing, and I will update you as it develops. Until then, stay informed, stay analytical, and keep watching the flows. This is AG Archivist. The metal is moving. Follow the metal. See you in the next video.